Debt Management Part 3, Understanding Different Types of Interest Rates. Last 2 weeks, we talked about the types of debt and credit card loan. This week, let's discuss more about the interest rates. Hi, I'm Eva Wong here, your wealth coach to achieve early retirement. If you wish to learn how to become financial savvy and to retire early, remember to subscribe to this channel here. In fact, you might not be aware that there are a lot of different terms used for interest rates. There are essentially 3 main types of interest rate for loan purposes. The first one is the nominal interest rate, then the effective interest rate, and the flat rate interest. The nominal interest of a loan is simply the stated rate on which interest payments are calculated. This is the rate on which loan accrues interest over a period of time. For example, a car loan of 100,000 at a nominal interest rate of 5% over 1 year would cost the borrower 5,000 interest. It's just as simple as using 100,000 the principal times the nominal interest rate. The effective interest rate takes into account compounding over the full term of the loan. It is often used to compare the annual interest rates with different compounding terms like daily, monthly, annually, and etc. For house loan, mostly the interest rate is compounding daily. Hence, the effective interest rate is higher than the nominal rate. A nominal interest rate of 5% compounded daily would equal to 5.127% per year. How do we calculate that? We use 5% divided by 365 days and compound over 365 days. The third type is the flat rate interest. It is normally used for car loan or personal loan. Flat rate interest is the type of interest that will stay the same on the principal loan amount throughout the loan tenure. Under the flat rate method, the interest is calculated based on the principal loan amount and not the outstanding loan amount. For example, the car loan of 100,000 with 5% flat rate interest for 5 years will have total interest payable of 25,000, which is 5% times 5 years times 100,000 principal amount. When borrowing money, we need to be careful on the types of interest rate being quoted. Banks like to use flat rate interest when quoting the interest rate for car and personal loan so that it looks cheap. Very seldom, the bank will use the effective interest rate unless being asked. It is the actual interest rate chargeable on the loan amount and it is always higher than the flat rate interest. Using the previous example just now for the car loan of 100,000 with the flat rate interest of 5%, we know that the total interest payable is 25,000. But if we calculate the effective interest rate, you will realize that it is much higher. We can calculate the effective interest rate using the financial calculator. Check out www.fmcalculator.com to get one. Let's try together to find the effective interest rate. First, we need to key in the principal amount, which is the PV of 100,000. Then, we key in the payment amount, which is the accumulated interest plus the principal amount, 125,000, and divide it by 60 months. The duration N is 60 months, which is 5 years. Then, we use the financial calculator to solve the rate by pressing rate. Answer is 9.154% per annum. See, 9.154% effective interest rate compared to 5% flat rate interest quoted by the bank. What a big difference. Never get cheated again by the low interest rate quoted. You can use the method demonstrated just now to calculate the effective interest rate. So please do remember to compare apple to apple. Never compare a flat rate interest with the effective interest rate. Start to find out the real interest rate, which is the effective interest rate, before committing to a new loan. That's all for my sharing this time, and thank you for watching this video, and I do hope that you like it. Comment below what you have learned from this video and do subscribe to my channel for more early retirement tips, and I hope to see you again. Bye!